The release of OpenAI's ChatGPT in November 2022 marked a pivotal moment in the history of artificial intelligence, especially for generative AI. Funding in the generative AI space surged dramatically in 2023 as major players, including OpenAI and Anthropic, recorded substantial increases in capital. Generative AI firms raised $25.2 billion in 2023, marking a nearly eightfold increase over the previous year. In fact, generative AI accounted for more than 1/4 of all AI-related private investment in 2023. But startups were not the only ones focusing on AI. Investment and deployment of artificial intelligence technologies became a massive part of companies' overall corporate strategy. This is perhaps best illustrated by the fact that there were over 30,000 mentions of AI on earnings calls by the end of 2023. And why not? S&P 500 companies citing AI on their earnings calls saw an average stock price increase of 28.6% in 2023. Obviously, this does not mean that their stock price grew because of them mentioning AI. As we know, correlation does not imply causation. However, it shows that more and more companies see AI as a massive growth factor. But amidst this surge in enthusiasm and investment, a pressing question arises. Is this behavior backed by sound fundamentals, or is this just an AI bubble? And if so, when might it burst? Financial bubbles are a recurring phenomenon in our history. They are often characterized by a rapid increase in asset prices, which is then followed by a quick decrease in the prices. These bubbles are often driven by exuberant market behavior, speculation, and irrational decision-making, leading to prices that significantly exceed the intrinsic value of the asset. And technological advancements tend to frequently lead to financial bubbles because of their unique characteristics that drive speculation and exuberant investor behavior. New technologies often promise to revolutionize industries and disrupt existing business models. This potential for significant change generates excitement and optimism among investors who anticipate substantial future returns. Additionally, during the early stages of new technological developments, there is often a lack of comprehensive understanding among the general public and even among investors. This information asymmetry can result in misguided investment decisions based on incomplete or overly optimistic information. Media coverage and hype around new technologies can further amplify speculation. Positive news stories, success cases, and endorsements from influential figures create a buzz that affects a broad range of investors, including those with limited knowledge of the technology. Then, the fear of missing out on potentially lucrative opportunities drives many investors to enter the market. This herd behavior supercharges price increases as more people invest based on the actions of others rather than fundamental analysis. Initial success and rapid price appreciation of new technology assets encourage more speculation. Early investors who see substantial gains create a feedback loop where new investors enter the market, pushing prices higher in anticipation of continued gains. Think of the dotcom bubble in the early 2000s. The advent of the internet promised to transform businesses and daily life, leading to an unprecedented wave of investment in internet-based companies. Companies with .com in their name saw their stock price soar, regardless of their actual financial health or business models. Investors poured money into these companies, driven by the fear of missing out on the next big thing and the hope of massive future profits. However, many of these companies lack sustainable business models and realistic revenue projections. The initial excitement and rapid increases were not based on sound fundamentals, but on speculative behavior. When it became clear that many of these companies could not deliver on their promises, the bubble burst. Stock prices plummeted, and many companies went bankrupt, leading to significant financial losses for investors. Another important thing to know about bubbles is the fact that they develop in stages. A financial bubble typically progresses through these 5 stages. Stage 1. Displacement. This stage involves a change in economic circumstances such as technological innovation or regulatory changes, creating new opportunities and attracting investor interest. Stage 2. The boom. During the boom phase, asset prices start to rise as more investors enter the market, driven by optimism and the expectation of future gains. Stage 3. Euphoria. At the peak of the bubble, prices soar to unsustainable levels. Speculation becomes rampant, and asset prices are driven purely by the expectation of selling at higher prices rather than on intrinsic value. Stage 4. Profit-taking. And during this phase, some investors recognize the unsustainable nature of the price increases and start to sell their holdings, taking profits. This stage often goes unnoticed initially. And Stage 5. Panic. This is when the market realizes that prices are unsustainable and the sharp decline begins. This leads to a rush to sell, causing a rapid collapse in prices. Now, knowing all of this, are we in an AI bubble? Well, maybe. If we are in an AI bubble, we are probably at the third stage, which is euphoria. Euphoria is why new startups like Inflection AI, Stability AI, and Cohere were all valued at over $1 billion despite generating minuscule amounts of revenue. Euphoria is why companies mentioning AI seem to gain value. Take a look at this. This bar shows the combined market value of Alphabet, Amazon, and Microsoft has increased by $3 trillion during the AI boom. And this other bar shows that these companies are expected to generate $20 billion in additional revenue from AI in 2024. As we can see, the market is currently valuing AI at a revenue multiplier of 150. Before this AI frenzy, Microsoft was valued at about 10 times its revenue, Alphabet at 5 times, and Amazon at 4 times. So, a 150 multiplier does strongly suggest that the economic promise of AI is being overvalued. However, this is not that simple. The previous figures are not enough to make a conclusion because first, we cannot fully attribute the increase in market value to AI promises. There are other factors that likely help these three companies see an increase in value. And second, the AI revenue figure is not enough. See, when the market invests in something, it does not expect immediate returns. Instead, investors invest their money in a company or a new technology for the potential to generate great returns in the long run. So, what might seem overvalued today might be completely justifiable in the next couple of years. And this is exactly the case with AI. McKinsey estimates that generative AI could boost worker productivity by up to 70%, with half of all work becoming automated sometime before 2060. This automation and productivity could create up to $4.4 trillion of new economic value. For context, the global economy was roughly $104 trillion last year. Therefore, generative AI could add about 4% to the world's economy just by itself, which would be a significant boost. So, there is plenty of revenue to be generated by generative AI. As we can see, AI's economic promise seems to be very real. However, this is exactly what makes a bubble almost inevitable. See, in every other financial bubble, the economic promise of the underlying technology felt real and in some cases even obvious. Again, think back to the dotcom bubble. People back then knew that the internet will have a huge economic impact on the world, and this is what justified high valuation and unsustainable growth, until all of it collapsed. So, if we are in an AI bubble, when might it collapse? Usually, it takes one significant event for bubbles to start collapsing. During the dotcom bubble, news that Japan had once again entered the recession triggered a global sell-off that disproportionately affected technology stocks, which ultimately led to the collapse of these companies. And during the housing bubble of 2008, the collapse of New Century Financial is largely regarded as the event that triggered the pop. In the context of AI, this trigger event could be anything from a declining demand for chips to the collapse of a major AI player. But even if you truly believe that we are indeed in an AI bubble, this does not mean that the entire AI industry is doomed to collapse. Sure, the stocks might collapse, but as history has shown, the really valuable companies will weather the storm and will emerge stronger than before. Again, let's look at the dotcom bubble. When this bubble popped, overhyped companies without a viable financial plan and business model like pets.com went out of business. But the pop also dealt massive damage to other, more fundamentally sound companies like Amazon, which lost over 90% of its market cap. However, because there was a solid foundation upon which Amazon was built, it was able to weather the storm and come back even stronger. And the same thing will probably happen in the AI space. When and if the AI market sees a huge decline, we will see many companies and startups cease to exist. However, despite taking a beating, many other companies will survive and might continue to grow in the future.